Leonid, please go ahead.
Thank you, Andrei. Basically, I'll maybe start with a very short introduction, and then we'll be very happy to answer the questions. So this year has been very successful, I think, for the banking system in general, and for VTB in particular. We are hitting record high profit, and we actually raised our profit guidance twice this year, and now we are targeting to reach over 300 billion net profit for this year, very likely over 310, which would be above 16% ROE. And we also see a very nice progression of key revenues, over 20% growth of net interest income and net fee and commission income. And coupled with very moderate cost of risk, which reflects the benign operating environment and the fact that economy and the performance, the economic performance and the credit quality turned out eventually to be much better than what we expected back in spring, summer 2020. And for 10 months, cost of risk was 0.7%, 70 basis points. We probably will see somewhat higher cost of risk towards the end of the year, but still the total cost of risk for the full year will be definitely below 1%. We also see acceleration of cost growth throughout the year, which is mostly linked to our continued investments into transformation into technologies and into our basically capabilities to improve customer experience and to offer ever improving service for our customers. Still, given that we see a very nice growth of net operating income, we managed to achieve very healthy levels of cost-income ratio, and we expect that the full year cost-income ratio will be below 40%. And that brings us to a very kind of comfortable position when we look into the next year. Another big factor which is happening right now in the market is the changes in the money market, changes of the interest rates. And throughout this year, we've seen a very significant increase and tightening of monetary policy and increase of the rates in the market. The key rate has increased by 325 basis points so far this year, and it is very likely, as the market sees it, and I think we fully share this year, that there will be another increase before the end of the year. But having said that, I also need to say that over the years, most of the large Russian banks in Russia and VTB definitely have developed much better capacity to cope with changes in the interest rates. And historically, I think we've been having very high sensitivity of net interest income to changes of the key rate. Now the sensitivity has gotten much smaller, and we've effectively hedged it, and we've achieved close to neutral effect on net interest income. However, this whole change in operating environment mostly impacts the growth perspectives, and we already see slowdown of growth towards the end of the year, and we definitely expect further slowdown of growth next year, because obviously higher level of interest rates create or suppress the loan demand both from corporate and retail clients. And on the retail side, this is further exacerbated by the central bank regulation, which has been recently tightening the regulation in terms of certain type of consumer lending, increasing the risk weights for them. And they're even talking about physically kind of limiting the consumer portfolios for specific banks, although there has been nothing certain in that respect. But this definitely means some kind of tighter rhetoric, at least more aggressive rhetoric from the central bank. This is why we haven't yet released our guidance for the next year, but definitely we will continue showing normalized profitability, and we will definitely see slower growth than this year. Another issue which is very much in the spotlight when it comes to VTB is capital and dividend plans. It is no secret that our capital buffers are not very generous, and we're actually running with rather thin capital buffers, which means that our capital planning needs to be very, very tight. This year, we improved our total capital adequacy by raising a lot of hybrid capital in the local market, which has been a very successful program, and we will definitely continue with that. But this doesn't affect the base capital, of course, and the base capital can be only replenished through net profit. And this year we had a specific case when the assets were growing fast and the regulatory profit. There is a difference between accounting profit and the regulatory profit. So the regulatory profit was materially lower than the accounting profit because some of the forbearances of the central bank have been basically canceled this year or phased out. Next year, we're going to have a different situation when the accounting profit and the regulatory profit will be harmonized, while the business growth will be much slower. So that would help. And that means that with all the tight capital planning and with capital buffers which are not very significant, we're still planning to pay the dividend for common shares based on 50% payout ratio, which would be, we believe, a very competitive, very attractive dividend payment. And based on current share price, that would mean above 12% dividend yield for the next year, which we believe will be a very significant factor of our equity story. More generally, we've seen our equity story kind of developing quite positively this year, probably somewhat better demand from the investors, and relatively good share price performance. Our share price has been up more than roughly 35% since the beginning of the year, which is better than the market average. And I think that going forward, as we continue with normalized profitability, as we continue adding up to the tangible equity, and especially if it is boosted by the generous dividend payment, that would be very positive for our further development of the equity story. So with that, I will be very happy to answer your questions.
Thank you very much, Leonid. Actually, to me as an analyst, it has been very inspiring to see such a turnaround in VTB's performance. And even more surprising, I think maybe it's the best performance in a decade and more than a decade, despite COVID, despite the CBR rate hikes, which would have been quite detrimental maybe a few years ago. And with this, I think the key question is how sustainable this performance, this financial performance is. So what we already know, what we have highlighted, is that loan growth should subside next year, partly because of the high rates. What's more uncertain, and maybe is the most interesting topic to discuss, is asset quality. How sustainable do you think the current improvement in asset quality is, and for that matter, the current cost of risk? And would you see any threat from the high interest rates on the asset quality side? I would be very grateful for the discussion of this, Leonid.
Well, it's a good question, because if you look at VTB's kind of asset quality situation, I don't think it's very much different from what you see across the sector. And if you look at the cost of risk that we've been showing this year, it's not also very much different from what the sector average is showing, or at least for the larger banks. And it is also true that when we were in spring, summer last year, things looked much darker than they eventually turned out to be. And although the COVID, the pandemic situation is far from over, and we're seeing not good numbers and not good statistics, both in Russia and even globally in Europe and elsewhere. I think that now we've come to a situation when it doesn't really materially affect the general economic performance and the credit quality and the credit worthiness of the borrowers. Also to a very large extent because of the various support measures that the government is providing. And so I think as it kind of basically looks now, the current situation is sustainable. And we expect, we haven't released the guidance for the next year, but I don't think that we would see high cost of risk next year compared to this year, because as it looks now, there is nothing which could cause that. And of course, if there is another sort of black swan situation, and it might come from different areas, I mean, it might come from some turbulences in the export markets, like oil and gas, although the current forecasts are rather favorable and positive. It might come from, I don't know, something geopolitical, although again, like things are already bad enough from the geopolitical perspective, and I think that they've been already priced in. So I don't think there is a serious expectation of further sort of exacerbation in that respect. And so basically, under the normal kind of course of business, yes, it is true that I think this current level of cost of risk, like below 1%, is sustainable. With regards to the interest rates, of course, if we see the situation that the central bank would have to really kind of hike the rates further and further and further, that could be a different story. But so far, our expectation is that, first of all, central bank has proved its capacity and its ability to fight inflation. They've done it successfully in the past, and I don't see reasons why they're not able to do it now. Our view is that central bank will continue with tight monetary policy for the next few months, and then probably by the end, and you know, it might be even above the current level. I mean, the key rate, and we might see another rate hike, like I said, before the end of this year, and maybe, you know, another rate hike in the beginning of next year. But if our kind of house view or expectation that things will return to around kind of 7.5% level towards the end of next year, and then inflation will really start to subside, and by the end of 2023, the key rate would be at the level which is kind of neutral, and by that time inflation would be also closer to the central bank target of 4%. So basically, if we see that situation under control and inflation gradually going down, then we don't see a reason why the cost of risk and the credit quality, the asset quality, shall be impacted by that.
Thank you very much, Leonid. That's great to hear. Another part where I see a strong turnaround at VTB is the ability to launch new products. And I would be happy to discuss, I would be glad to, would be grateful if we could discuss that. So what I mean is, first of all, retail brokerage, as VTB had historically been the leader in institutional brokerage and institutional asset management.
And still is.
But, of course, by default. But what has changed is that VTB was able to capture all these retail brokerage opportunities, I would say, boom in Russia, which is still continuing. And a part of my question would be what you would expect from this business line for the next year, if you're in a position to discuss that. And there is one particular question, is that I think on one of the calls, maybe a couple of months ago, Vladimir Potapov, the head of the VTB Investments business unit, mentioned that VTB could consider developing a retail brokerage and perhaps even asset management in Europe. taking into account that VTB has a fully licensed bank in Germany. And this particular question is whether there has been any progress with that, or maybe any progress with planning this. Thank you.
Well, starting with the latter, I think that if and when we have something like that, it would be properly announced. At this point, I have nothing to say about that. But generally, you're absolutely right. The kind of the biggest turnaround story within VTB for the past couple of years is the technological transformation and the big effort and investment we're making into technologies, into things which are both visible to the clients and not exactly visible to the clients, like improving internal processes, dramatically cutting down time to market, improving the reliability of our systems, and things like that. But also, obviously, launch of new products and new apps and new services for retail clients, for small and medium-sized clients, and the business that you mentioned, the retail brokerage is obviously probably the fastest growing business within VTB for the past couple of years. And it obviously originally it started from a kind of very low start and demonstrated very aggressive growth, but then the growth naturally kind of slowed down, but still it has very large potential, just as the rest of this market in Russia. But VTB is obviously very, very well positioned to catch up with these developments. We have a super platform, and it is very highly rated. It is appreciated by the clients, and it is the best in class. And we truly believe that this business is going to continue to grow. Also, very importantly, it's very often that growing businesses do not show good profitability, but this is not the case with VTB in My Investments. And on a standalone basis, it demonstrates very good profitability. And now it is visible, a sizable part of our net fee and commission income. And the revenues from that business for 2020 were roughly 17 billion rubles. And for this year, we're targeting 30 billion rubles, as we've said in the past. And we are very much on track to achieve that. So the question that very often comes up is like, to what extent it cannibalizes the retail savings, the customer funding from the retail clients that we have. And we don't think it is the right way to look at that, because yes, historically, when we saw this huge decline of interest rates in the Russian market over the period of like few years, obviously many retail clients were dissatisfied with that. But we don't think that it really cannibalized our retail savings business. We don't look at this way. We rather look at, we rather think that these dissatisfied clients would have left anyway, and probably if not the retail brokerage market, they would channel their money into, I don't know, real estate or something else. But obviously, it's very good that we had this retail brokerage business, and we've been able to continue servicing these clients, to continue giving them the financial solutions that they needed. And now the question whether or not we see the reverse cannibalization, I also don't think this is the right way to look at things, because obviously the increase of interest rates that we're seeing right now, it's not so dramatic, right? If the retail deposit paid, I don't know, 4% a year ago, now it pays, for example, 6%, 2 percentage points up. Still, people who look at the stock market, they're thinking in different categories. They're thinking in terms of like 20% up a day, right? And it doesn't mean, yes, of course, there is some flow between these two categories, right? But we don't see that in material numbers. So we don't believe that the increase of interest rates is rather a competitive factor between different banks than a competitive factor between bank savings and the stock market.
Very much, Leonid. Yeah, that indeed seems to be the case. And continuing to these added services, VTB also is developing its ecosystem, but I think VTB is much more moderate in doing this compared to, say, Sberbank. And the big question around that, which is often discussed, is the new regulation and VTB's reaction to this potentially onerous regulation, which is not yet finalized. And basically, here I would like to test my own understanding. I think that VTB's approach could be relatively simple to the ecosystem developments. If these new requirements are too onerous, if they weigh too much on VTB's capital, then VTB may just choose to do projects in a capital light way or equity light way via partnerships with direct investments.
True. But of course, first of all, it is too early to say because central bank issued the kind of first draft a few months ago. They were supposed to issue the updates based on the feedback they received from different banks, and we as VTB, we gave them very detailed feedback, and I believe other banks did the same, other large banks. They were originally scheduled to issue this updated draft before the end of October, but it's been delayed somewhat. But I think we are expecting to see this second draft sometime in the future, hopefully before the end of this year. And based on what is there, we will make another evaluation what potential capital impact this new regulation might have. This is also, they call it the ecosystem regulation, but this goes beyond ecosystem per se, because in my view, ecosystem regulation is something which is mostly from the kind of consumer protection side, like, protecting clients from limiting their choices. But central bank is rather looking at what they call immobilized assets, which includes real estate, which includes all equity investments, including, for example, infrastructure finance, which is often structured as equity investments, et cetera, et cetera, et cetera. So based on the kind of shape the regulation will be taking, but also another important thing is that central bank, I think they've said it publicly, that they don't want this new regulation to be a shock for the banking system. So they intend to phase out kind of implementation that would be comfortable for the banking system, that would not cause sort of kind of immediate problems for banks. So we believe that, first of all, we will have enough time to adjust ourselves, our policies, our capital, our planning to the new regulation. But based on the final kind of draft that we will see, we might, eventually decide what to do. Whether we should structure certain businesses in a different way that they would be less capital intensive, et cetera, et cetera. But I think at this stage, it's safe to say that we are comfortable that it would not have kind of huge one-off immediate effect, and that we, as well as the rest of the banking system, will have enough time to adjust our businesses and our policies and our principles to that new regulation.
Thank you very much, Leonid. I would like to spend some time on discussing your dividend calculation formula, as in my experience, sometimes it's the most difficult concept to grasp for some investors. And just to remind everyone, Leonid, correct me if I'm wrong, VTB uses the same approach. Basically, the target is to equalize dividend yields on the ORDs and the prefs. And to do this, a certain equation needs to be solved. And in this equation, the yield on the prefs, the target yield on the prefs, is calculated as one based on their notional, which is 521, if I'm not mistaken, billion rubles for the two types of the prefs. And on the ORDs, this dividend yield in the equation is calculated based on the average price for the ORDs on the year for which the dividends are distributed. So for the dividends distributed out of this year's earnings, we will only know the average price of the awards after this year ends. And this formula also means that the higher is the price of the awards, the higher is the DPS. So my question would be, first of all, did I get it all right? And does this approach still apply? And the second question is, if there are some limitations on capital, would VTB consider limiting the dividend distribution on the prefs, at least temporarily, so that holders of the awards receive this payment in full based on this particular formula?
First of all, your understanding is absolutely correct. You summed it up in a very correct way. I would say that yes, there is this equation, but frankly, it's not really rocket science. So and basically, yes, you would know what is the exact average share price for 2021 on December 31st, but now we are, for example, like a few weeks from, we're in the middle of November, so there is like 6 weeks before the year end, and given, if we assume that there will be no sharp kind of changes in share price before the year end, then it's not so difficult to evaluate the average share price for this year. And I think for the next year, in the eyes of the management, it is kind of sacrosanct to pay the dividend on the ordinaries based on this 50% payout ratio. Historically, for example, last year, we reduced somewhat the amount of dividends on preference shares, as it was agreed with the government. And this question whether or not VTB will be willing to reduce the dividend on the preference shares, it's not really the question to us. It's the question to the government as the majority shareholder, which ultimately makes the decision on the dividend payments. I think, we don't have anything to communicate at this point. That would be very fair to say. But what I can confirm is that we are definitely very much going to make this dividend on ordinary shares based on 50% payout, which would mean over 12% dividend yield based on current share price. If this would be a certain strain to our capital adequacy next year, it's likely, and again, we've said this a number of times in the past, it's likely that we might split the dividend payments into two parts and pay first portion of dividends in July in the third quarter, and let's say the next portion of the dividends, the second portion, sometime in the fourth quarter of next year. So that's the way it looks now.
Thank you very much, Leonid. That's clear. One more topic I would like to discuss is technological transformation. We've already mentioned new products, but it's not just about new products. It's also about changing and merging and optimizing core systems. And with that, we see the increase in OPEX, which is much higher than inflation, and for which you had guided long before. And I'd like to discuss your expectations for the trajectory of OPEX and OPEX growth in the next few years, and in particular, which period would be the most OPEX and maybe CAPEX intensive with regards to technological transformation plans?
Well, this year has been so far and will be cost intensive for that purpose, and the next year will be cost intensive as well. And we believe that this transformation, this current transformation, will be completed next year. But of course, the technology, the investment is not something that you do once and for all, and it's a continuous kind of move. But it is true that this year and next year we are adding really kind of a lot of additional one-off costs to our cost base, which is related to the upgrade of our systems. And then going forward, this pressure will be somewhat lighter. But of course, effective cost management is always the priority, and cost income ratio is a very important indicator that people are looking at internally. And depending on the inflation developments, and depending on the general market environment, I think we will be continuing to really find the new ways, kind of ever innovative ways to optimize our cost base. The big, potentially a very, very large source of cost optimization is the branch network, because obviously this is something very cost intensive. So far, I think we are happy with the current size of our branch network, and we don't expect that to change over the course of kind of next 2-3 years. But then, kind of looking into a more remote future, it is reasonable to assume that in that kind of future, banks, including VTB, will be further reducing the size of the branch network, and that potentially could be a very important source of cost optimization. But like I said, now we don't have any kind of specific plans in that regard.
Yeah, thank you very much, Leonid. And just in case, to remind everyone that VTB has historically been very acquisitive in the core banking business, starting with Bank of Moscow in 2010, 2011. And in recent years, there were several regional banks acquired. And just a question for me, do I understand correctly that these intensive banking acquisitions, they are largely finished? So going forward, the concept, the key idea is to integrate them, and perhaps new acquisitions could be aligned with new products, basically with a focus on non-banking space. Do I understand this philosophy correctly, Leonid?
Well, yes and no. First of all, it is true that we don't have a lot of appetite for acquisitions, and we both banking and non-banking. Well, first let's start with non-banking, because this is easier. Yes, we do have private equity business. It is part of our core kind of banking platform, and we might do some acquisitions from time to time. When they're done, they're properly announced. We also do exits from time to time. So this is a kind of flow of transactions. It's a limited number of actually holdings and transactions that we have, but this is part of our core business. So private equity is something which is not really acquisition per se, because when you do private equity, you normally acquire a smaller kind of a minority stake between, I don't know, 10 and 30% maybe. But if we talk about really acquiring businesses and integrating them onto our platform, I don't think we have specific targets, and we haven't been really, discussing that publicly. And this is not the philosophy that we pursue. We rather, like I said, pursue partnerships. And when we do partnerships, we might acquire certain minority stakes to really kind of boost these partnerships, but this is not the primary objective. If we talk about banks, first of all, we don't have much capital. Secondly, we don't have, like I said, much appetite, because integration of these banks has gotten much more difficult over time because of the legal environment. And we haven't fully legally integrated these 3 small original banks that we bought a few years ago. And although kind of you have to differentiate between the actual business migration or the client migration and the legal integration, which might happen somewhat later. And this legal integration has become a more difficult process over time. because of some changes in the legislation. So I don't think we're really looking at this. And our absolute priority is, of course, the organic growth, also developing partnerships with various kind of key players in various segments of the market, like e-commerce, real estate and something, but with the purpose of basically using those partnerships as the channel of customer acquisition.
Yeah, thank you very, very much, Leonid. Yeah, these partnerships basically are quite visible, so they are a very important topic for discussion. What I would also like to discuss is Pochta Bank, or the JV that you have with the Post of Russia. And basically, VTB has officially announced that Pochta Bank's Post Bank strategy is going to be changed or revamped, and I would be grateful if you could spend a few minutes on this.
Well, yeah, we before the end of the year, we are going to really finally kind of reintegrated within the group. So right now it's a JV, so it is integrated just as the P&L result. And when we finally make it a subsidiary, it will be integrated line by line. So it will not really change the P&L, but it will change some balance sheet positions. Well, will help us, by the way, with the liquidity coverage ratio, because Post Bank is basically funded for retail deposits. But overall, given its size, we don't expect that it will have a material result on our overall performance. Of course, when it happens, we will give the full kind of breakdown and the performance and everything. But generally, I think it would be fair to assume that the impact on ROE would be close to neutral, and there will be no material impact on capital either. But this change of strategy, well, first of all, our partnership with Russian Post as the kind of second shareholder remains very robust, and the bank will continue using the branch network of the Russian Post as its own branch network, and that doesn't change. And so there is a very strong connection with the Russian Post. And the Russian Post itself is also kind of undergoing massive changes in terms of improving the quality of their branches and becoming better and faster and everything else. And of course, Post Bank as this joint franchise will benefit from the improvements that the Russian Post is showing. But I think we altered our strategy in a way that Post Bank will be more really a distribution channel for the products of VTB Group, and not really an independent kind of center of developing its own products. So that's the biggest change that will happen. And that would also help to improve efficiency and the cost performance.
Thank you very much, Leonid. Thank you very much for this overview. Let's hope that VTB's turnaround will continue despite COVID. Maybe you'd like to add some remarks, Leonid.
Well, thank you very much for hosting me, and I just really want to say that we are very, very open. If you want to reach out with any questions or comments you might have, and please reach out anytime you want, and just follow our announcements. And next big announcement will be in Q1 next year, when we publish the full year results. But before that, we will publish November numbers. So we're November in 11 months. I think you will have a very good picture of what's going to be for the full year. And so please follow us. Thank you very much.
Thank you very much. Have a good day.